Well, so much for going away for holiday and missing a couple of quiet weeks. First, earnings season in the USA has been mixed, at best, and lofty expectations have not generally been met, especially with regard to the 6 of the Magnificent 7 who've reported, namely Alphabet, Amazon, Apple, Meta, Microsoft and Tesla, Nvidia reports off quarter. Second, the Bank of Canada and Bank of England cut interest rates, the Fed did nothing and the Bank of Japan raised them, so monetary policy remains a hot, if increasingly confusing topic. And finally, the news on the American economy has turned more mixed, as unemployment has risen, manufacturing data disappointed, and housing sales figures proved weak yet again. As a result, we're going to eschew company-focused comment this time, even though it's a big week for insurance, with interim results from Just Group on the 13th, Aviva on the 14th and Admiral on the 15th. Instead, we're going to look at this midsummer stumble, the possible reasons for it, and indicators to watch to see if it's a short-term sentiment swing or something more fundamental. Now, there are 3 possible reasons why stock markets have taken a dive, and don't forget that sovereign bond markets are rising during this, as government bond yields fall and commodities are also holding relatively firm. As for those reasons, first, markets have priced in a cooling in inflation, a soft economic landing and a drop in interest rates, a dream scenario. But any divergence from that path means there could be more volatility ahead, and right now, rate cuts are coming slowly, inflation's proving sticky, and the data from America particularly is weakening when you look at jobs, manufacturing and housing. Second, markets have gone up fast, and in the case of American stocks, they look expensive relative to their history, on price earnings, market cap to GDP, and the Shiller cyclically adjusted price earnings or CAPE basis. And finally, the American corporate earnings season was not all milk and honey, as we've discussed, and there weren't many upgrades to forecasts as perhaps were needed to maintain share prices' upward momentum, at least in the near term. This is particularly important with regard to the Magnificent 7, when they represent 1/3 of the S&P's 500's valuation, and the S&P represents 60% of global market cap. Of those 6, only Meta really pleased, so the US has become narrow, and better breadth would be a good sign. Now, this could just be a summer stumble amid low volumes, in keeping with the old saying about sell in May, go away and come back in mid-September on St. Ledger Day. Also bear in mind, the Nasdaq, for example, is only back to where it was in May. Hardly a disaster after last year's 5 years of galloping gains. Even so, calls for American interest rate cuts are getting louder and louder, but investors may need to be careful what they wish for. A US slowdown is not priced in really by markets. If anything, investors were more concerned about American overheating earlier this year. And those with long memories will remember how frantic rate cuts from the Fed in 2002 and 2007-8 failed to stave off a bear market in stocks because the economy tipped over and corporate earnings fell faster than the headline cost of money. Ultimately, it's valuation that sets a high and a floor, and they're the best arbiters of prospective returns over the very long term. But to test near-term market sentiment, investors might like to watch 3 indicators. The first is the VIX, the so-called fear index, and that measures expectations of US stock market volatility in the months ahead. The long-run average reading since 1994 is 19, and it's usually a good counter-cyclical indicator. Sustained periods of low readings, 12 or below, speak of investor complacency and likely trouble ahead because it won't take much to shock them. A sustained run above, say, 30 suggests there's panic around and there may be some bargains appearing, but any shakeout could still be violent. And all that, let's face it, just distills Buffett's maxim about being fearful when others are greedy and greedy when others are fearful. The second indicator is the yen, given its pivotal role in global market liquidity right now. Huge short positions against the Japanese currency have been funding long positions elsewhere, and now the yen's rallying, well, that's forcing the closure of those shorts and liquidation of the longs they funded. The yen carry trade. At the very least, it's a big coincidence that the yen has surged just as Western share prices have wobbled. If the Bank of Japan backtracks on its promises of more rate hikes, that might help. Although whether that then stokes global inflation expectations is another challenge, and rapid cuts from the Fed and other central banks might stoke money supply and liquidity in the West, but again, fuel inflation fears too. Maybe why gold's holding relatively firm. And for those looking for an indicator that looks at both US markets and the US economy, and we're focusing on them really because they're the biggest in the world on both counts, then nothing's more usually helpful than our old friend the Dow Jones Transportation Index. It's lagged the Dow Jones Industrials and lost momentum. Historically, that's been a bad sign, though the past is no guarantee for the future, as it's tended to speak of economic weakness. That indicator really could do to start trucking again, or the summer squall could get a bit more stormy. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.